For Wall Street Media, I'm Mike, I'm here with Doug, and we'll help you make money in the stock market with information you can't find anywhere else.
Hey, my friend, good afternoon.
Hey, good afternoon.
Oh, we've got video from Rich, right?
Yeah, we do. We have Rich Gordon, fixed income market strategist of a corporation, and he discussed the government intervention in financial markets during 2008 that he states helped in the US to avoid either an extreme recession or depression in 2009. However, the general economic environment remains weak, and he suggests investors constantly reprocess portfolio positioning.
Yeah, he says the markets are irrational, right? Which, of course, we know, and we've been screaming from the hilltop here for 3.5 years, right? But he also said that some of the bonds remain undervalued, corporate bonds, right, not treasuries, remain undervalued because he thinks investors are both too pessimistic and also, which I didn't think of, right, and that's why we need Rich, is he says they don't have the liquidity. Their trading budgets have been cut by 30%, 40% different, varies at different institutions, so that they can have that capital for other things than just the normal trading.
But for the long run, that means that's a good thing, right? That means it will recover eventually.
Yeah, but he's saying that people should take a look at them now, and he shows great charts and stuff of what's happened with bonds and spreads during, before, and after many of the recessions.
Oh, let's watch the clip real quick.
It looks like all of the government's intervention in the financial markets during 2008 will help the U.S. to avoid what could have become an extreme recession or a depression, the likes of which haven't been seen in 80 years. The Fed's balance sheet has ballooned from 6% to over 15% of GDP in the last 6 months, and risk takers have finally reappeared, causing risk assets of most types to rally over the past 4 weeks. However, the general economic environment remains weak, and because of the fragile nature of any apparent recoveries in asset prices, investors need to constantly reassess their thought processes and portfolio positioning throughout 2009. Last week, we outlined the case for portfolio managers to neutralize their duration positions if they had been long during 2008. On the first trading day this year, the 10-year yield broke through a well-defined support level that was established last July. The yield remains above the trend line despite continued economic reports during December and early January showing the U.S. economy slipping into a deep recession. Longs are facing a torrent of Treasury issuance in 2009, expected to be nearly 2.5 times the amount issued in 2008. The laws of rational markets dictate that the Fed's bailout from the credit crisis will eventually result in higher government yields as the massive stimulus gradually reflates the economy. But we've also seen that over the past 1.5 years, financial markets can move violently and irrationally. Accordingly, those short of duration in the government market should be aware that 222 and 205 on the 10-year represent key technical resistance levels. And if both are broken, it probably means a next leg down in yields will prevail. Last week, we pointed out that the refi index had spiked due to the sharp drop in the 30-year commitment rate. The sheer volume of refi requests is overwhelming mortgage originators and servicers who have redeployed personnel from their originations areas to do workouts on existing troubled mortgages. Despite the operational issues, refi volumes have remained very high, and the extra monthly incomes for homeowners from lower rates couldn't come at a better time, given the severity of the current economic downturn. But it's important to keep in mind that the homeowners saddled with little or negative equity in their homes can't refinance. Homes hyper-appreciated in the U.S. between 2003 and 2006. Mortgagors that purchased homes prior to June 2003 were able to refinance into low fixed-rate mortgages during the last boom. Home buyers that purchased during the period between 2006 and 2008 have seen a sharp contraction in their home equity. And since the decline from the peak of prices is more than 25%, many of them now have negative equity in their homes. Because they lack sufficient equity to qualify for a conventional mortgage, this group of homeowners has limited ability to refinance despite significant rate incentive and the fact that they've maintained their incomes and are considered to be prime borrowers. Also, People with mortgages that are over the conforming loan limits are having trouble taking advantage of these record low 30-year rates. The chart shows the difference between the rates on conforming and non-conforming loans. It's a reminder of the gulf that's developed between financial products that have direct government support and those that don't. So even though conventional mortgage rates have reached their lowest level ever, the combination of borrowers with insufficient equity and mortgagors with balances above the conforming loan limits are likely to keep refinancing levels well below those in the 2003 wave. Turning to the credit markets, the past 4 weeks have seen buyers return en masse to the investment-grade corporate sector, lured by the combination of high absolute yield levels and historically wide spreads to treasuries. In this next portion of the show, we'll evaluate the current spread levels on corporates on a default-adjusted basis as well as versus the S&P. First, let's look at corporates on a default-adjusted basis. Even after the recent spread tightening, the sector remains fundamentally undervalued. This is the case in both the cash and synthetic markets. The chart shows the relative value of corporate spreads as a function of the 12 months forward Moody's speculative grade default rate. The regression indicates extreme cheapness at current levels, which means that investors apparently continue to expect an outcome on defaults much worse than is justified by current recessionary conditions. More likely, it reflects the continued balance sheet constraints on leveraged investors and the reshaping of risk profiles on Wall Street dealer desks, where cash inventories have been slashed by almost 70% since the beginning of the credit crisis. On the synthetic side, the current spread level of 215 basis points implies 22 defaults out of the 125 name pool of investment-grade credits over the next 5 years. On a fundamental basis, this seems unlikely. But here again, technical pressures rather than fundamentals have been the biggest driver of this product. And there are two key factors that continue to weigh on synthetic spread levels. One is the fact that there's almost no synthetic CDO creation now and for the foreseeable future. This has been a large technical factor keeping synthetic spreads tight during 2006 and the first half of 2007. The other thing is the likelihood of more forced deleveraging of CDOs as default rates increase and actual ratings downgrades to the corporate names occur. Second, we looked at corporate debt versus stocks. These two sectors have seen the majority of institutional inflows over the past month. As almost every risk asset has reached historically cheap levels during this downturn in the credit and economic cycle, investors have focused their bottom fishing activities recently on the sectors that are the most liquid and those that are benefiting either directly or indirectly from government sponsorship. The chart shows the yield on BAA investment-grade corporate debt as well as the earnings yield of the S&P 500. The earnings yield is simply the reciprocal of the PE ratio and provides a measure of stock value which is more comparable to fixed income credit investments than some more common stock price metrics. The chart shows the difference in yield between the two measures going back to 1990. The blue shading indicates periods of economic recession. Here are several observations. First, corporates tended to sharply underperform equities just before or during the early parts of the past 3 recessions. We attribute this to the institutional rather than the retail investor base that dominates the corporate markets. Institutional investors tend to sell corporate debt and buy duration-matched treasuries well before actual economic deterioration sets in. Individual investors in the equity markets tend to be less proactive with their asset allocation changes, reducing exposures and increasing cash balances only after time passes and the economic deterioration morphs into reality. The second thing is that under the simple comparison of yields, corporate bonds were actually cheaper versus stocks in each of the previous 2 recessions. Finally, we note that the recent rally has brought the yield advantage of BAA corporate debt versus the S&P to less than its long-term mean. If you'd like any of the data in today's show, give us a call and we'd be happy to provide it for you.
It's a pretty grim outlook, right?
It really is. Now he says that individuals are usually behind institutions when it comes to the recessions, right? Mm-hmm. That the institutions usually already start to make moves before they actually feel it, where he says the individuals actually wait until their holdings drop and then move into cash, right? And I think that's what's happened, right? But one thing that he says that we've been saying here as well, right, is that you need to be extremely nimble now, and you need to keep a very close eye on your portfolio, right? And an example of that is that yesterday we've been using stocktwits.com, free stuff, guys, great stuff if you're a trader. If you're a neophyte, don't set foot there. Just go, you can go and learn. But like Citi yesterday, I jumped into Citi. Right early in the morning at like 5:16 or 5:18, I saw it was bouncing all around. Got up to 5:28. Right, I was out. Well, normally, that's the kind of trade that I would have made. I was out a few minutes later, right, at a dime profit, and it went up to 5:40 a little bit later. I got out the rest of it there. It actually ended up going all the way up to 5:80, and I was sitting crying like, oh my gosh, as usual, I sold too soon,
I bet it's down now.
Today, it's at about $4.53, and I'm not crying that I'm out of it that quickly, right?
So this is a time, due to the fluctuation, this is a time for day traders?
Yes, it is, but not like minute traders.
Right.
It's ridiculous. I'm a story stock guy, right? And I had Given Imaging, right? GIVN for you civilians out there, right? And they had a great story from Needham, right, where they have the pill camera, and we talked about that the other day, and it's approved in France, and it's so much better than the current horrible things they do to people for colonoscopies. And I really liked that stock.
And you liked, as in the past?
As in it closed out today. Right. I kept moving the limits up. I bought into it at about $9.50 when they presented at Needham. Right. Told the people that watched the show about it. Right. Went up 5%. It was at $10. I thought that's great, but I moved stops up. Now, normally I wouldn't have stops on something like this because it's a long-term story.
Okay.
But the market's so irrational, and people are just jumping in and out of things like I've never seen in my time trading on Wall Street. Right. That I keep moving the stops up and up and up, and I'm out of it. It stopped out. Now, picked up 8 or 9% in a couple of days, right? Which I'll take in this market, but I would never be so anxious and keep moving my stops all of the time, right?
So it becomes more speculative. Is it more like the Chinese market used to be, or?
No, what I think happens is that people know that the market is irrational at the moment.
So everyone is
and
cautious.
so people are so crazy cautious, I see the guys when I'm watching on StockTwits, right? And these guys are in, and they must be out of it as they're typing out, right? And that's what I did with Citi yesterday, and thank God that I did, right? And that's what Rich is saying, is that you need to keep an eye on your portfolio, right? This isn't buy and hold. Buy and hold is gone. I'll let you know when it's back. It's long gone. I was a buy and hold guy, right? If I liked the story, I got in, right? And I watched what happened.
Even a year ago, your hold was more like a week, maybe.
Yeah, well, that's buy and hold.
Okay.
But now my hold is in minutes, right? And if I have to get up and go to lunch, or when you and I are running out to do something, right?
You're looking at your stocks.
No, I got all my stops moved up to where they're going to be, right? And I'm stopped out of Given right now, and I like their story very much, but just things are so volatile because I think people don't know. We're down at like 8,100, 8,200. We were at 9,000 a couple of days ago, right? People don't know what the hell's going to happen, and that's an extreme gyration in the market. Guys, if you're a trader and you're looking for ideas, go to StockTwits. If you're an institutional person, give Rich Gordon a call and get his information. He's one of the smartest, most respected guys on Wall Street. And if you're an individual trader, take a look at StockTwits.com. You're going to see an awful lot of the most respected traders out there.
Perfect.
Thanks, Mike.
You're welcome. We're here every day at Wall Street Media. You can find us directly at wsmco.com. Thanks.